the main characteristics from an investment perspective, it's been pitched at a price earnings multiple based on what they expect to make this financial year of around about 16 to 21 times
so
earnings.
Is that an expensive price for stocks around private insurers?
There aren't many examples. There's only one other listed health insurer, that's NIB Holdings, which is a smaller regional operator. The initial commentaries seemed to be that it was a bit on the high side. Most industrial stocks, or on average industrial stocks, trade around 14 times for the sector. So if you look at it that way, it's expensive. But health stocks tend to attract a premium because it's a defensive sector, and so there's very stable earnings. The health insurer I mentioned, NIB, is on about 18 times earnings. So it's not outrageous, although at the higher end, 21 times, it does maybe look a little bit expensive. Or put it this way, it's not a bargain.
Okay, so if I'm a retail investor, what would I be looking for? What are some key markers in terms of the prospectus? Is it dividends or return, expected return, and how the business operates?
Yeah, well, that's right. It's dividends. The yield is around about 4 to 5%, which is quite good, but you can get better from the banks.
So yeah, how does that compare to a bank stock?
The banks, I think, might be around about 6% or possibly a bit more at the moment. I think Telstra's also a bit more. So you can get better, but it's certainly a decent yield if the earnings forecasts on which it's based can be actually be realised. On that note, the MD, George Savvides, was pointing to a 10% rise in operating earnings in the current year, and an improved operating margin. In effect, he expects the insurer, and it's not the most efficient of the health insurers, and there are about 33 of them. It's certainly not the most efficient at the moment.
So there's more earnings upside coming out from the cost argument of the cost end of the insurance company.
Well, that's right. That seems to be an assumption that more efficiencies can be squeezed out of the operation. And that in effect means that the insurer takes on the health industry a bit more on costs. For example, the hospitals on its list. So it basically has to tackle this problem of medical inflation, which has been spiralling for some years now. And so it's a moot point as to whether they can succeed in doing that.
So that comes into some of the risks of the float. So if I was an investor thinking about the float coming ahead, what are the key risks there?
Yes, the inability to realise these efficiencies is a big one. I think one of the main ones is the regulatory risk, because in this industry, almost everything is dictated by government, basically, including the premium increases. Every year, the funds have to go to government and get the sign off. In the past, the government's maybe been sort of happy to tick off some larger rises because it's actually a beneficiary, or has been a beneficiary because it owns Medibank. Maybe this will change a bit, and in their sort of purer role as just being a regulator, they may take a harder line on that. There's also the question of rebates, which were wound back. The Finance Minister, Matthias Cormann, suggested today that when the budget allows, they might be pumped up again and restored, I guess, to where they were.
But we're not talking about a company that hasn't been proven before. So it's got a track record. So it's, in terms of the range of risks, it's fairly middle of the road. Would that be a fair assessment?
It's certainly been a proven operator over a large period of time. Although recent earnings seem to actually have been a flat, but there are some extraneous items there. So it certainly got the track record, but there is also there's always that X factor of a sudden change in policy.
Okay, well, thanks very much for your time there this morning, Tim.
No problems, Eric.
Thanks.